Welcome to Credit Matters. I'm Mike Skirbo, Standard & Poor's Corporate Ratings Group. Today we're going to talk a little bit about North American REITs. I'm joined by Beth Campbell, who's a director in the real estate team based here in New York. Beth, thanks for joining.
Thanks, Mike.
So you recently published an article. Maybe talk a little bit about what's our outlook for REITs.
Yeah, Mike, our outlook for REITs is stable for the year. Basically, we're looking at modestly positive job growth and consumer spending. Those provide sort of the underlying supports from a demand perspective. And despite the economic uncertainties that are still lingering, we do see some other key credit supports for the sector in terms of very limited new supply will help the absorption of space. We expect rent roll downs to ease across all property sectors this year, and we also look for the REITs to continue to maintain good access to capital.
How about ratings migration? Well, what have we seen recently, and what do we expect in 2012?
Yeah, well, we're coming off the heels of 2 years of consecutive upgrades exceeding downgrades. That follows the 08-09 period of very dramatic downgrade activity. Looking ahead for 2012, the majority of our 70 rated REITs do carry stable outlooks. We do expect that to be maintained. However, on the margin, our positive outlooks outnumber the negatives 3-to-1. So we do expect perhaps more upgrades than downgrades this year, and that would be driven. We're looking for a few key things for those 6 REITs that have positive outlooks. About half of them we're looking for the successful integration of acquisitions that they did last year. For the other half, we're really looking for expected improvements in fixed charge coverage.
Okay, how about let's switch gears maybe. It's clearly a capital-intensive industry.
Yeah.
What do we expect relative to capital for the REITs?
Yeah, as you noted, REITs are extremely capital intensive. They're really reliant on external sources of capital for their funding needs. A couple of things we do see that REITs have maintained good access to capital, and while base rates are low, spreads have widened a bit for REIT bonds, so we've seen a real migration towards other cheaper funding sources, such as bank term loans, the preferred stock market. We do expect those will remain sources of capital for REITs this year. And also, to put it in context, we think their funding needs are very manageable. When we look at the debt maturity profile facing REITs this year, it's really pretty limited. It's about $6 billion of unsecured debt maturities in 2012. That's less than 6% of their total outstanding unsecured debt.
Sure. How about by property type? Maybe talk a little bit about what our view is on the various property types.
Yeah, we're expecting continued gradual improvement in occupancy for all subsectors over the next couple of years. Really looking for overall, on average, the same-store net operating income to grow consistent with last year's levels, about 2 to 3%. We expect outperformance in apartment, factory outlet center, and mall. We expect that to really offset some continued comparatively weaker operating results in industrial, in office, and in certain strip center retails. And maybe just talking about office, or focusing on that for a moment, we've seen a real bifurcation there in that recovery. We expect that to continue with the CBD outperforming suburban, but both to just have a very gradual slope to the recovery, really in contrast to what we saw coming out of the last downturn. And maybe on the opposite end of the spectrum, the outperformance of multifamily, we look for that to continue this year. Very favorable demographics, very favorable renter projections, but we are starting to see some development increase in that space, which longer term could have implications for rent growth prospects.
Sure, sure. Maybe one last quick question. Any other takeaways that maybe you haven't talked about that we should, viewers should be cognizant of in 2012?
Sure, yeah. In closing, maybe just another point, we do expect debt service coverage measures overall to remain pretty stable despite the improvement in operating fundamentals and the cheap capital costs, really because we also are looking for many REITs to continue to cull their portfolio. So they'll be selling sort of the bottom percentage of properties and reinvesting those in better quality but likely lower yielding assets. So to offset that dilution, that offset is going to come from the core improvements that we had talked about.
That's great. Appreciate you joining.
Okay, thanks, Mike.
We'll see you again next time.